Hello and welcome to FreeFX. Today is the 21st of December, Monday. We have been through a lot of event risk in the last couple of weeks. We've had the Fed rate decision last week, and the week before we've had the Bank of England rate decision and the Reserve Bank of New Zealand rate decision, and the week before that we had the ECB rate decision. So it really has been a month of extraordinary momentum, and the Fed rate decision I've discussed already in my previous video, but just very briefly, what we saw from the markets was an appreciation of the Fed doing what it had already said, which meant that there wasn't a lot of movement. On the night, volatility was immediate on the release of the rate decision, which was a hike, the first in 9 years, but it wasn't really market moving afterwards. So if we look at things like the US dollar, which is a trade weighted index of all the majors, Euro USD, Kiwi USD, Pound USD, we can see that on a daily level. Okay, so the rate decision from the Fed was here. You can see this thin wick and a very small body. A lot of indecision, therefore, on the day. It closed positive, and then the next day it sort of went up towards 12,200. And then on the Friday it almost lost everything that it gained, and today it is a down day so far as well. So we're essentially stuck between 12,000 or 12,050 and 12,200 and not making much progress. If you look at it in the bigger context, that's where we are. We're kind of high lows, but the highs are not really so far gaining ground that much since the beginning of November. So we really are, we have been through a lot of event risk. We are in a situation where even what was meant to be the biggest of them all, the Fed rate decision, didn't actually provide a change in direction or perhaps fuel to really spark a rally in the US dollar. And certainly the US dollar wasn't the only one. There are plenty of currencies that had a similar journey, if you like, and I could maybe pick the Euro US dollar, which is obviously a very popular one because of being a very liquid pair. So we could certainly have a look at that in a moment, but I would like to start with the Kiwi dollar because this is one of the pairs that I follow the most and has, for me, a lot of interest really as a maybe less crowded trade than the Euro US dollar. And we can see that we are still at the bottom of this downtrend, or not the bottom, but certainly we are possibly at the end of it. We're not sure. There seems to be certainly very little conviction at the moment, in either direction. And instead of continuing to move lower, we've recuperated from this 64.5, 0.64, and up to 0.68, which essentially is where we were back in middle of October. Now, the interest rate decision was here, this candle, and then the next day the Kiwi fell by about 100 pips, almost a solid candle, and then recovered, and today is an up day. So looking on a shorter term, on a daily, from in about a month, if you like, from the third week of November, we've had high lows and high highs. So, and indeed, even going back further from September. However, there are a lot of issues with that, in my opinion, because, well, in the opinion of a number of Kiwi analysts, and that is that the US dollar has the potential to raise interest rates further, and And obviously, if the US dollar becomes an appreciated currency, it will attract investment. Certainly, the Kiwi has been facing some difficulties because it relies heavily on being traded on the back of its interest rate. So the carry trade, buying Kiwi Japanese yen or Kiwi US dollar, except probably nobody bought Kiwi US dollar all this time from way back in July 2014. But certainly for Kiwi yen, that's been a trade that's provided that carry from the interest rate differential. But certainly on the daily chart, you can see that the Kiwi yen the carry trade has become a very crowded, to use that term again, trade, and it's made some correction to the downside and struggled to recover since. This is not to say that it will reverse to these levels 45 tomorrow, but it certainly doesn't look poised for an aggressive upside momentum. So the ATR, you can see on the dailies down to, I think it's 119. The height here, it was about 216. It is getting quieter, by its own kind of past history. It's not the quietest, but certainly quieter than after all the commotion during the Chinese market crash back here in August. Having said this, my first chart when I opened this video recording was the FTSE or UK 100 shares index. This is the equities index for UK-based companies, but my interest with this really, it's not as a just trading this, is really because it gives me a measure of sentiment in a way, because I understand that some companies do better than others, but as an index, taken without looking at individual companies' performance, it is traded as such, and therefore the sentiment it describes is one directional. So when, for example, the market crash here in China back in August, it didn't matter which company was doing well in the UK 100 shares index. This was obviously, it was a combined effort. It's a drop of this magnitude from 6,800 to 5,900. That's nearly 1,000 pips. Okay, that's huge for this particular index. So this really makes for exceptional movement. In the main, this really has been, since the drop back in April, it's been a fairly quiet index, sort of gently nudging back down to this, what I call a psychologically important round number. And the 6,000 number really has been back here in 2011, 2010 was a strong resistance and possibly supply level, selling back off to 5,000, recovering back in 2012, but still not being able to break. And then finally 2012, 2013, it broke up to these new heights. Now, what's interesting, this is the daily chart, so we can go into some detail, is that back in 2013, you can see that the 2nd of January, this is this huge candle here from 5,000, essentially 875 to 6,050. So that's a huge candle, and we did actually see that precisely at the beginning of the year, this break made the difference, because after this, look at where it went. Okay, this, there is something to be learnt about this, because we're back at this level, and again, it's the beginning of the year. We've gone quite some time without breaking it, and we've attempted it back in August, September, and now this month as well. There was a false break here, and we're back on it. So at the end of last week, okay, we had on Friday it's called the triple witching, as in WITCHING, which is, as you know, the expiration of a quarterly expiration for the year of futures, stocks futures, and options. So the point of that is that there is obviously a lot of potentially selling off of assets, and that can, to some degree, explain that down candle. The 11th of December, this one here, that was the Friday before, and again there was a bigger sell-off and it broke, but that didn't sustain it. So essentially we're playing up and down on this 6,000 level, and the fact that we haven't really moved from it or below it seems to suggest that sentiment is poised for a break. So we're just waiting for that catalyst that will push this lower. Now, whether that will happen on the first day of 2016, like it did back here in 2012, on the upside, 2013 to the upside. So 3 years on, perhaps this will happen to the downside. But certainly, it is pressing on this level heavily, and having dropped so far, this tells us the downside is more probable, but not certainly a certainty. Why does this matter to to currencies? Well, if we took something like oil, for example. Okay, so some of the biggest companies in the index in the FTSE 100 are oil companies, Royal Dutch Shell and BP. So if we looked at oil, if I can bring it up, seemingly I haven't got it already, so I'll have to create that. If you give me one moment, and that should be easy enough to do. So the oil is actually on the oil is crude oil is at historic lows. Today it's jumped up back above 35. It's gapped up actually, so it compressed all the way to these lows, nearly at 34, and then today it gapped up, but it's not been a positive day so far. It is 4 o'clock in the afternoon GMT, so it'll be just about 11 o'clock in the US, and this doesn't really seem to be a very strong move to shake off the doubts that it may continue lower. So it is, in a way, thinking about back to the UK 100 index, how effective this drop has been in impacting equities and earnings. So it is something to really keep an eye on, how commodities have an impact. And indeed, in this picture, where a commodity may be moving because of oversupply, like in the case of US oil, but also in the case of a speculation on the speculation, therefore this being traded speculatively as a commodity, but also as a financial instrument. So if, for example, during the great financial crisis of 2008, this dive bombed from 150 down here to 34, which is essentially just roughly where we are now, if not slightly lower. And the drop has been, almost it sort of recovered almost 2/3 of the way. So that drop was recovered about 2/3 of the way, and then we've lost it all. So whether we're ready for the next spike up or not, to get something of this magnitude and then back down, they take something extraordinary. So we are really looking for. This particular drop here, there's been obviously the problem of oversupply in oil, but it's not really been one single catalyst. It's been a build-up in concerns and companies obviously selling off hardware and letting staff off and operational difficulties. So, it's been a case of real economy impacting the speculative asset and vice versa. So it is a spiral effect or combination. But we are now, at these lows, and again, where will this go? Okay, it's not quite a cycle, but it's certainly a significant level. As you can see, the 40 level was instrumental here in 1990. That was during the Gulf War. They spiked up that level and then back down. So this level registers across time. Okay, 2003, maybe a coincidence, and 2009 at the bottom of this, and then now we're just below it. So the fact that we've broken it in the greater scheme of things doesn't mean much, because it has to continue to really convince people that this could go as low as, I don't know, 17 or 20. So it really is something that that is on the mind, I'm sure, of many people who have exposure to US oil or who are involved in the industry. But for us, really, this is just telling us that we are at a very particular point in time. And this is where I'd like to link back to currencies, because although currencies are not always related to commodities in such a direct way, when we have the deleveraging of commodities like crude oil of this magnitude, when we have the deleveraging, because I think that's probably the best word to describe something like this, the deleveraging of the US equities index, the S&P 500, from the 2,100 down to 2,000. See, we've come down here on Friday now, attempting a recovery, but not quite there yet. So when something like this that's been going on for several years, in fact, since 2009, so 6 years of profit and then struggles. Now, I've mentioned this before. S&P 500, FTSE 100 have their own sort of 7-year cycles. You see one here, two, and then the third is sort of hugely overextended, almost double the previous two in terms of size. But in terms of time scale, we are in the 7-year. The peak of 2000, 2001, 2007, 2008, and 2014, 2015. Now, it does look poised to respect that cycle. Now, it seems to have taken a slightly different path, sort of climbing quite high. So the shape of it is different, but the time period is roughly the same. And you can see that with all these peaks, the ascent was much more gradual than the descent. Okay, and you don't have to measure it; it's very obvious to see. So it may seem such an impossible journey for this to drop down to 750, for example, or even to 1,000. But it's not, because you look at the 1,000 sort of 500 level here, and a 750, and that's it's not 750 actually. It's 7,500 because of the decimals readings. So that's a huge drop, and so really, and that happened in a very short time, from the beginning of the year. Okay, basically January of 2008 to January of 2009, 1 year. It may seem like a long time. Insofar as a lot of, perhaps some of you following me, appreciate that a lot of people will be certainly trading from home like me. It may not suit their trading style to think in such big terms, or perhaps it's something to consider in terms of trying to find trends going forward, and then trading them on an intraday basis, or maybe holding trades for a couple of days to a week, but certainly no longer than that. But I can't make assumptions. There'll be some people out there who will be trading from home, and as you'll know from watching my videos, like me, holding trades for several weeks or months. In that case, if one were prepared to hold a trade for 6 months to the downside and watch it go, in this case, say from 1,575 to 1,250, and then back up to 1,400, say 30, and then back down and pushing further down to these lows, then the greater rewards will come in this span of 12 months. So it is instrumental to gains over a long period of time to be prepared to watch trades fluctuate by big distances, and yet maintaining one's fundamental bias in one particular direction. So the S&P 500 is poised for a downturn. The US oil is poised for either a break of this 35, 34, where we are now, and continuation to the downside. Having temporarily broken the 40 level, but as per 2009, it could be a temporary break and a recovery. So even 500 or 600 pips are nothing in the bigger scheme of things, if that's the kind of outlook that you want to gauge from looking at charts like the daily or the weekly. Then we have the currencies like the Kiwi US dollar, which if you were to put a line here, you would see that the top of this descending trend line has been hit again 2014, 2015, and we're coming to the end of the year and we've hit this trend line, if you like, once, twice, third time. So this, for people who use the classic sort of 3 touches on a trend line for confirmation, could be in this slightly shorter term trend, could be confirmation that will be continuing to the downside. And yet, if we went to the monthly chart, you would see a different picture. So again, looking at the long term, you would see a trend line rising from here, touching, and then touching again in 2015. So this would be telling us that we have actually bounced and are making a correction. Possibly, if this continues, then it's a reversal, and we are ranging back up to essentially the top of this massive channel almost. But things sometimes work through technical analysis, just like planned on the chart, through lines and levels, and sometimes they play out on the fundamental side more strongly so. And certainly with the US dollar in a situation where it is at record highs, but it has a bank that is moving ahead of the game compared to other banks and is really on the back of its economic recovery of the US employment figures and positive data, or at least some of it is positive. Some of it is still like wage growth and labor participation is still troubling to some degree. Something like something like New Zealand has as a strength the interest rate, which is 2.5, compared to the US, which is now 0.5. So 2.5 minus 0.5 is a 2% interest rate differential. So buying the Kiwi at this level, if you see this as a trend line, at this level appreciating up and holding that trade will earn you a swap, so overnight interest added to your transaction. If you held this over several weeks or months, this would be a very good trade. But New Zealand rests on the strengths of not just its currency, but its dairy trade. So from a commodity point of view, unlike, say, the Canadian dollar, it's linked to the production of milk and milk powder and milk derivatives. Dairy products are, I think it's something like 30%. I've seen different figures, but roughly 30% of its GDP, and a lot of it goes to China, obviously Australia, but China. So the relationship with China is crucial, and doubts over China's health certainly have been a problem for New Zealand's exporting of milk powder. And it seems at the moment that that concern has not been cleared, and it seems that the El Nino weather event is forecast to be the worst in many years, and it could really hit even the best prepared farms in New Zealand. And this could certainly have an impact on the productivity. Shortage of water supply for crops, not for crops, for cattle, and certainly there would be an impact that would be very tangible. So weather events, again, when it comes to commodities of this kind, are very important. Equally, if you were trading something like corn or wheat, these would be tied to events and seasons and cycles tied to seasons. So we do have to bear in mind that we have a problem here. The technical analysis seems to suggest that there is a lot of room to the upside. Okay, and this could be true of other currencies, but again, the fundamentals seems to differ. So at this point, it's very important that we're coming to the end of a year, which is a very thin liquidity environment where contracts are taken off, big positions are taken off. Now, taking off a position, obviously, if you're an institution holding, Kiwi dollar, selling Kiwi dollars against the US dollar as a forex trade, this would have been, entering somewhere near the top. Maybe nobody can get it right to the last pip, but somewhere close to here, and holding it, conservatively, maybe to the break of 70, and then taking profits. Maybe some others might take profit a bit later, but we come to the end of that long down trade, that sell, and so as those positions are taken off, there are no sellers left, and so the currency will recuperate. But at the same time, that's not the same as strong demand. So if the currency is just recuperating because of lack of sellers, all that has to happen is for the beginning of the year and the return to normal trading conditions for more sellers to come back in and push this further down. Okay, because historically, yes, we come to maybe a bottom of a long trend line, but it's not the lowest it's ever been. There's no saying we couldn't come back down to these levels at 0.40. There's nothing saying that couldn't happen. It may be less probable than a bounce to the upside. And the other thing is that central banks have a huge say at the moment in how they determine directional flow of money. So when the Bank of New Zealand was cutting rates throughout 2015, and it was basically trying to talk the currency down because of the effects on exports, it did actually successfully manage to take that currency and push it down to what it considered to be more appropriate levels. And yet it is heavily traded by the bank's own reckoning, and so it is difficult for the bank to stem the flow of investment into currency traded assets like forex or other Kiwi related assets like maybe futures. And so at this point, if the bank, which at the moment seems to be happy with its latest rate cut, I'm thinking it will do for now, and so they're not going to consider further rate cuts at the moment. So if the bank stops talking down the currency, although it keeps saying that it's too high, they like it lower, but they're not going to cut rates anymore. So they're talking it down still, but they're not going to act any further, this really leaves the market open, because if the bank isn't going to intervene, then there's nothing to stop this appreciating, essentially, except something of a catastrophic nature, like El Nino hitting New Zealand hard, as predicted, but beyond what they can cope with, and that would obviously hurt the dairy and subsequently, obviously, holdings of Kiwi dollars abroad to purchase their products. So this would be the kind of event that would go beyond the usual conversation about monetary policy and money flow related to that side of the market. So to sum it all up, what I've tried to illustrate is that we are coming to the end of the trading year, and we have these question marks hanging over our head, which go across different levels, from commodities to equities to majors like the Kiwi dollar, and obviously something like the pound dollar. I know it's not everybody's favorite necessarily, because the euro-US dollar is the one that always hits the headlines, but the pound dollar has had an interesting run this year, and we must look at the fact that we've come to the end of the trading year. We come to the end of the trading year, and this has been the 2015 performance from January over here. Let's take the very beginning there. So the beginning, it was here, just where we gapped down. So we started the year essentially with a down trade from 155.75, so just under 156, traded heavily to the downside, and by April we reached 1.40, 45.50, let's say, or 46. Okay. And now we are at 1.48 something. Okay, 1.49. So we have a very interesting currency pair, because the pound is the currency that was in 2013-14 meant to be raising the the interest rate, and the Bank of England didn't deliver. So this was really a speculative appreciation, and then a subsequent deflation of that, essentially coming back to the same levels as when we started. So really, from the rise of the talk about the Bank of England raising rates back here in July of 2013, June 2013, which is roughly when Mark Carney was invested in sworn in as the new governor of the Bank of England after Mervyn King. So from here to now, we haven't moved. So all of this was a big bubble of speculation, and then the next bit was again a minor secondary bubble of speculation about a rate rise, and we're back to where we were. This shows you in a way that the market listens too much to its own chatter, and it doesn't appreciate sometimes that nothing has changed. And this presents huge trading opportunities, of course, but if, say, somebody decided that they were short the pound at this point, obviously they wouldn't have necessarily gone short here and held throughout that, but even if they waited from 2013 to 2015, it may be the case that they should have come clean and gone short here and made a profit. But if overall they had an exposure to short pound, say long euro pound, short pound Kiwi, then they might have done that. But also, if they'd been long the pound, then they might have waited for this to come back to these levels, and maybe to see the sign of a turning towards some kind of change in sentiment, so that the pound would actually start showing signs of appreciation again, based on the changing fundamentals. For example, a Bank of England change in sentiment in the wake of the Federal Reserve raising rates. Carney might consider that the Bank of England could, maybe some of the Monetary Policy Committee might consider a change in tone, and the voting might alter from 8-1 in favor of keeping the rate unchanged to maybe 7-2, 6-3, and so on. But that really remains to be seen. But Carney has decided to extend his stay to the full 8-year period at the bank. This is just news this month. So that continuity obviously is a calming influence on the pound, and it may be that there are lots of factors obviously going into this. There's the uncertainty about the exit of the United Kingdom from Europe. And also there have been other things that have moved this market. For example, if you looked at September 2014, big gap here, we had the Scottish referendum, if you remember. This big gap here, just where I'm pointing. And this obviously didn't last very long, but then the downtrend continued. So some events have a sort of localized impact, but trends are hard to buckle. Okay, so the overall trend of the pound is difficult to read, because after the drop in the great financial crisis, we haven't gone very far. It's been very choppy, and as I've pointed out before, we are in a way, it's very easy to describe this as a cycle, but it certainly there are arguments to see that this side and this side have very similar, not only ranges on levels, top to bottom, but also in terms of time period, they seem to follow a similar shape and direction, which means that we may see the next leg up. And it doesn't have to be sudden, it could be gradual, just like from 2001 to 2008, a 7-year cycle. 8 to 15, that's another 7-year cycle. So the next 7-year cycle could start, with a difficult start like here, but it could start sometime in the next, few months or days or weeks. We don't know. So again, the pound dollar, just like the Kiwi dollar, it shows yet again that no matter which asset class, and whether it's commodities or equities or currencies, and no matter which instrument, whether it's pound dollar, Kiwi dollar, we haven't looked at the euro dollar, but again, or the actual dollar itself, no matter what you choose, it is very difficult to trade at the moment, because it's the end of the financial year, or the end of the trading year. The UK financial year is in April. So the question remains, it's about trading. And trading is, by definition, an exchange of goods for a profit, where possible. So if I went to the market and I wanted to buy fish, I went to the fish market or to the fish stall, and I went at the end of the day, and the fish that come in at lunchtime from the catch in the sea, and the trawlers that come into the market, and the fish have been packaged and put on the stalls by lunchtime. Now, if I wanted to trade for the catch of the day and I went in the evening, would that be the best time to trade? Well, I think we all know the answer to that, and the answer to that would be the best time to trade would be as soon as the fish had come in. Now, we have trading sessions during the day, so for the purpose of the example we're using, imagine that purchase of fish would be your intraday trader, choosing maybe the overlap between the London session and the US session. So the New York Stock Exchange opens at 2:30 GMT, and the London opens at 8 a.m. GMT. So between 2:30 and 5 o'clock GMT, that would be the best overlap. Really, you get the New York Stock Exchange liquidity and the London liquidity. So then you choose your instrument to trade, but certainly in terms of choice, because of the liquidity, you get much more choice because there'll be more activity. So more things will be active. And if we expanded that idea to to buying something throughout the year, not just at a particular time of day, the month of December is considered to be the best for profit taking, for rallies. The so-called Santa rally, being a Christmas sort of time of the year where historically equities, stocks have rallied as a final push, where liquidity is thin, and therefore it's easier in a way to push things around a bit, and so in a way that may influence the way that things go. But certainly, for one reason or another, this year that hasn't necessarily been the case. We've not seen a huge rally in equity, certainly. So, but the time of year is tricky because we may have or may not have a final push in stocks or equities. But certainly for currencies, it may be very tricky because when liquidity dries out, currencies and trends may struggle. So it becomes very tricky to trade. So finding something that is worth you investing your time and money in is tricky. Again, going back to our example of a market, you wouldn't want to, if you wanted the best choice, you'd stay away from going to the fish market in the evening when all the best fish was sold. You find the less appealing catch, what remains of the trade of the day, and so you wouldn't really get any bargains, or you wouldn't get any it wouldn't be a good trading environment basically for your money. So just to wrap up, we have the end of today, then tomorrow and Wednesday, Thursday and Friday, some countries start closing up shop for the Christmas Eve and Christmas Day, and other festivities, whether related to Christmas or not, but coming to the end of the year. So it will become difficult to find meaningful moves that one can trade for big swings. On the other hand, there is the issue that volatile instruments like yen crosses, look at the pound, the dollar yen, for example, has been quite volatile of late, with the Bank of Japan not expanding its monetary policy. So the yen appreciated. This was Friday last week, and look at this huge drop from 123.50 to 121. That's 250 pips. Okay. So there are big moves that can happen at the last minute, literally, and this means that we can't discount big moves. But it's a little bit of luck, and we can't really trade on luck. And it is possible that big moves will occur, just like here during the Chinese market crash on the 24th of August. Just to illustrate that, I was long another currency pair, the pound kiwi, but certainly the pound kiwi at the time wasn't really poised for such a big gain. So the pound kiwi gained something in the region of 1,000 pips and then closed at something like 580 pips up on the day. And I was actually long that currency pair at the time, expecting to ride it long term as I am now. But I was actually monitoring the trade at the time, and I saw this huge swing, and I closed it. I caught the majority of that swing. But those are rare events, and you could miss them, or you could be on the wrong side of them and be stopped out, or you could be losing a lot of money. There are different approaches to that, but certainly we can't expect to trade on the basis of catastrophic events happening. They are events that by their nature are unpredictable. So it goes without saying that trading like that is looking for a very risky strategy, which it's very difficult to make consistent profits on. Put it this way. Probably certainly more of a recipe for making consistent losses, but that's a different topic. So closing up, we are coming to the end of the year, and this may be my last video for 2015, and I may do one between Christmas and New Year. But if not, I wish you a Merry Christmas, and I will see you shortly, and good luck trading.